Hi, everyone, and welcome to this CPE and IRS CE eligible webcast, What to Expect in the Upcoming Tax Season. This 50-minute CPE session is brought to you by CPAPracticeAdvisor.com and Drake Software. Drake is a maker of tax and accounting software and has consistently, for about 20 years, been ranked really high in the CPA Practice Advisor Reader's Choice Awards, especially for customer service. I am Isaac O'Bannon. I'm managing editor of CPA Practice Advisor, and I'll be your moderator today. I've worked with technology, CPAs, tax professionals, and others for more than 25 years. The CPA Practice Advisor was founded in 1991 and provides digital, print, video, podcasts, and other resources for tax and accounting professionals. So before we get started, let me explain how you're going to earn CPE or CE credit on this webcast. The event is about 50 minutes and qualifies for 1 credit of CPE or CE in the field of taxes. If you want that credit, you must stay with us for the entire presentation. During the webcast, we will display 4 polling questions. In each poll, you need to record an answer. This is our verification that you are still watching the webcast, and I will alert you that the polling question is, here comes number 1, here comes number 2. After the event, you'll be presented with an optional post-event evaluation survey, and your CPE credit will be sent to your email address that you used to register for today's webcast. Note that you can also get multiple CPE credits for different people that may be watching from the same monitor. So if you're at your conference table and you've got 2 or 3 people watching, that's fine. You will just need to let us know who they are. You can also ask questions during the presentation. At the bottom of your screen, there is a question blank, and we'll try to get to some of those today. Anything that's not answered today, someone will follow up with you. So today I'm joined by John Sapp. He is a CPA since about 1988, and he's the Chief Revenue Officer at Drake Software, where he helps shape the future and growth of this tax company. Is one of the largest in the nation. He has served in a variety of roles at Drake Software since 1995, including as CFO and Vice President of Sales, Marketing, and Education Divisions. And so now I'm ready to begin. And John, is the 2024 tax season going to be as crazy as the last few years?
I will say a couple months ago, I didn't think so, Isaac. But I think we definitely are learning differently as, everything kind of gears up, and it's kind of like riding a bike and you top the top of a hill, and then all of a sudden you realize maybe your brakes aren't working as good as you thought they should. So I think we're picking up speed toward having a very interesting tax season. And, a lot of our challenges come into play trying to figure out which ones are the most important to deal with right now. So what we're going to do today is take just a real high-level overview of some of the issues that we believe are going to impact all of our tax practices this upcoming year. And, as you mentioned, Drake today, we have over 70,000 tax offices that utilize our tax product. And as you mentioned, our customer service, we have a lot of interaction with those customers. And a lot of these things, as we think about the wide swath of different types of tax offices that are out there, and they're as diverse as the American tax system that we have, and it's complex. I think one thing that would be beneficial, and I think this brings us to a very early polling question, which if I was attending for CPE, I would be a little, running through the door trying to get my name on the list here. So I think we're going to just start out with a polling question about who's attending today and what types of firms we have online with us.
Okay, I'm making sure my mic was on. All right, so the first polling question we have today is, how many people work in your tax practice? And those are professionals. So are we talking 1 sole proprietor firm, 2 to 10, 11 to 25, 26 to 50, or 50 plus? And John, if you switch over to the surveys tab, I believe you can see that. For our attendees, we'll get those results out to you guys in just a second. We're going to give a little bit more time so that people can make sure they get their questions in. This is the first of 4, just to keep you apprised of that.
Okay.
And if we can go ahead and get that pushed out, I guess.
There we go. and it looks like well over half of those that are attending today have 10 or less people working in their tax practice, which I think is pretty representative of where most tax practices in the United States are today. Most of them are in the smaller segment, what we would consider a smaller segment.
Okay, I guess you were waiting for a little more banter from me. Yeah, and it's really these small practitioners, or even the 2, 3, 4 staff firms. They've got their head so deep in work, whether they're really focused on tax or whether they're a broader service company, that they don't always have the time to keep up with all the latest tech, the latest trends. They can't spend 2 hours reading the latest news all the time, especially once tax season hits. So these presentations is really going to be a good summary, I think.
Yeah, no, there's no question that most of the smaller tax offices, they serve a local community. Even if they're in a big city, they serve a local segment within that community, and we talk to them a lot about the different issues that they're facing. And I think getting accurate information in a timely fashion, especially the things that may blindside them in the upcoming year. One thing's for sure, in the next 60 days, their phones are going to start ringing as articles in, their local newspapers start picking up about the upcoming tax season and things they may need to be aware of. So is that probably long enough for the poll?
Oh yeah. Actually, we could have pushed it on, and you're in control of those slides. You can push it as far as you want.
Well, I thought we'd just look back just a minute to get started here on where we are in the number of returns and the refunds that are processed, because a lot of times, especially early part of the tax season, last year, you'll notice that we had a pretty significant drop in the average refund. I think the average refund went down, from around went up from 21 filing season to 22. Up by about $300, and last year it went down about $300. And the challenge with that, when refunds on average go down, it's not that the $300 is a big deal. Like when we're sitting here talking about it in this context, it's like, well, $2,700, $3,000 is not as big a deal as we might think. But where it really became a big deal this year was when refunds dropped. You have folks that are on the cusp of a refund versus a balance due return, and we saw the balance due returns go up. And it's always been one of our tough conversations as tax planners and tax professionals, is how do we deal with that? We should see a normalization for the upcoming filing season, where more folks are their expectations line up with what the realization is whenever they have their taxes prepared. And most of us, as we prepare them for that, hopefully we're guiding them toward doing their W-4s accurately and making sure that they're withholding on the for the individual's preparers. Sorry, I got distracted by the questions that were coming in. And on the pro versus DIY side, we still see around 60% of the offices. And I'll just point out the 2023 filing season numbers were through July. So we will see that tick up a little bit. We did get new numbers today. We haven't updated the slides for the latest numbers for the 2023 filing season. Along with that, we've also seen a lot of talk this year, especially with the advent of additional funding for the Internal Revenue Service with audit rates. And as we think about our clients and the low percentage of them that actually have an actual examination, we know that it doesn't really it's not really indicative of challenges they may have with their filing process, because notices have not necessarily went down, and notices are something that all of us have to deal with when our client gets one. Now, GAO did look at this, and it was some, if you look at the last bar there, at least not the earned income tax credit, but if we look at this last bar with the 5 million or more and 2%, yeah, that's a high percentage. But I think we all know that, in 2020, the IRS closed around 180,000 exams on people under $25,000, and they only closed 750 on those over $1 million. So roughly 300,000 audits were closed under 500,000, and only 891 for those over $500,000 in income. So while there are a higher percentage of those returns that may get audited, there's fewer numbers of audits being done. And what that means is, 200,000 audits had earned income tax credit associated with them. And there was a couple studies last year about some of the bias within that earned income tax credit audit selection process. And so the IRS has recently launched new initiatives to increase audits in larger companies. It may not be, the whole thing is about bringing fairness back to the tax system. And starting this month, the IRS is sending compliance letters to 150 foreign companies. Soft notices is what we would call them, which I happen to hate, soft notices. But the IRS has mentioned that EIC audits, they're basically going to drop dramatically. And those EIC audits, the earned income credit will be the refundable credits also. We're going to see more due diligence audits around those refundable credits, but fewer actual audits of the credits. Now, the challenge, of course, with due diligence audits is they don't really audit the accuracy of the tax return or the accuracy of the refund. They're auditing the accuracy of the paperwork that's retained or the paperwork that's kept in the actual administration by the tax preparer of the tax preparation process. So we're going to see the IRS issued about 16 million notices in 2022. Most of those were for math error. But we are going to see fewer EIC audits in the upcoming year. And the IRS has indicated that they're going to focus all their compliance, not all of their, but the majority of those new funds that they have for audits are going to flow in through partnerships, especially partnerships that are of some size, 10 million in assets, where they are comparing now last year's balance sheet or last year's equity accounts with the beginning balances for the upcoming year. And if there's a discrepancy there and there's not an explanation attached to the tax return, they're going to start focusing on those and trying to find out. They believe that's an indicator of potentially something wrong with the tax return. So current year, beginning year balances, if there's not an explanation, you can expect a notice on those. Large partnerships, there are about 75 of the largest partnerships in the country that will be receiving notices in the next few weeks that they're going to examine those. And the idea here for the IRS is that they focus on higher income individuals. Number one, there's fewer of them. But number two, they're more complex. Now, the challenge is, roughly the no change audits that happen, there are a higher percentage of returns that actually get changed with additional tax owed in the lower income spectrum than there is in the upper income spectrum. We hope that that's because, paid preparers in that higher income spectrum are making sure that those returns are done accurately. The IRS also is expanding the work in their John Doe summons on digital assets. We're working on broker reporting, which we'll talk more about in just a minute. And then, of course, FBAR non-filers, they're focused on counts over $1.5 million. They also have mentioned specifically misuse of 1099 NEC or miscellaneous for labor brokers, where an LLC may have received the 1099 NEC, cash that money and give it to an individual, and it's not tracked back through to the individual return. So there's a lot of those things the IRS is looking at, trying to do things more efficiently. They've also specifically called out AI being used in those partnership return audits. Again, a lot of data there with those larger returns, and we can expect the IRS to pay more attention to them. This is mainly a slide just to kind of think about what's coming down the pike. Our child tax credit numbers are going to go back down in 2025. Our suspension of our limitation of the PEAS limitation on itemized deduction, our personal exemptions are going to come back. Limitation on deductions for SALT, and then QBI, which we've all grown used to. Probably one of the larger ones we all need to pay attention to is estate planning. where our state exemption is going to drop back down to the $5 million range. So we obviously need to pay attention to all of that as we go through the upcoming filing season, and start thinking about our retirement plans for our clients and all of the things that come along with the child planning especially. So I think that takes us to our next polling question, Isaac, which I think goes along with kind of what you were talking about earlier as far as clients getting their information.
Okay, I also wanted to note for everybody that these polling or the slide deck will be available for download at the end in the resources section of the screen viewer that you're looking at. You may be able to do it now, or you can wait. But here's polling question number 2. Where do you get most of your up-to-date information throughout the tax season for legislative updates? Your options are IRS releases, professional association events such as this one, webcast, CPE credit stuff, or other. And John, we did spend a little bit too much time last time waiting on the results. And I wanted to, and that was my fault, I think, but I wanted to note also, it looks like some people have a little difficulty with the survey. Once we push the results out, if your screen does not automatically go back to the slides, there should be a little blue X next to the survey window that you're looking at. That's for the viewers. Now back to you, John. Let me look what we've got going on the surveys. And it looks like people are getting it from all sorts of places, but mostly IRS official releases and events like this. And I think we can push that information out to the users now.
There we go. I'm glad I'm not in charge of making all this technology work together. It was nice when the IRS, at least told practitioners we could rely on things like their FAQs, going forward as we look for authoritative sources for our, especially with, all the different websites out there that are just copying and pasting from other websites or redirecting folks to different websites. So it's good to have a good resource that we can rely on. And I think the IRS publications are probably one of the best. So the big question here is, will we get an extender bill? And if any of us paid attention to the political environment in DC, I think over the last, I don't know what it's been, 4 or 5 years, I guess we've had fairly a very difficult time even keeping the government open. And so tax in general has been one of those things that if there's a turn in the administration and a turn in our houses of Congress, normally it takes a wide swath of party affiliations within both of the houses and the executive branch in order to get a large tax bill passed. But there are some things that we're hearing could potentially still get passed by the end of the year. And there's one just came through the last couple of days that is not on the slide, but our bonus depreciation, a lot of folks on the Senate Finance especially seem to be aligned that, as our bonus depreciation went from 100% down to 80%, it's going to continue to scale down over the next few years. That is one particular item that there may be some agreement on. Our research and experimental expenses, research R&D credit versus R&E expensing. That's also something that I think there's a lot of pushback in Congress right now around that, and potentially they may address that and allow some additional, instead of having to amortize over 5 years for domestic R&E expenses, there may be some push to have a level of expensing continue on, at least for another year. SALT, there are members of Congress in both parties in states like California that are highly impacted by the SALT limitation. And potentially we might get something around SALT. So districts in those high tax states like California, it's still unclear. I want to make that very clear. No one can guess, I don't think, what might end up being part of any particular type of deal, especially as we think about, what was just proposed by our new speaker to kind of divide out the way the new bills may be passed. And then finally, there could potentially be, there's quite a bit of pushback right now around 1099K initiative, which we're going to talk about in just a second, but that could potentially get pushed out another year. We got it pushed out last year to this year, and potentially we might see that pushed out one more year. So we'll see if that happens. Again, all of those things are just as you see those pop up in a news story throughout the next month or so. Definitely would suggest that you pay attention to those, just to make sure that if something does happen, you can at least go back to one of those trusted sources that we talked about before and find out what's happening. So the things we're going to we know are going to impact in one way or the other our upcoming tax season for 2024, 1099Ks, employee retention credit, a lot of the hangovers around that, digital assets, clean energy provisions. You're probably already getting questions about those as customers have made purchasing decisions this year, especially Corporate Transparency Act, a lot of changes and surprises. Actually, we had some surprises over the summer around that with E&O insurance especially, and then security aspects. So we'll talk just real high level about some of the security requirements we have for the upcoming season. So the 1099K is something that was mainly for businesses that had digital payments, and that mainly credit card payments was when it first came into play. And all this is geared around the tax gap and compliance efforts that the IRS has. So the more information they have, obviously, the more they can reconcile those audits. For those of you that remember, they still have the audits where they go in and compare the actual lifestyle of a taxpayer with the actual taxes they're paying and try to pay attention to that. We're going to see more of that going forward. But the 1099K bill was really around trying to get those digital payments into a reporting mechanism that would allow them to be reconciled on the tax return. Now, the $20,000 limitation, more than 200 transactions, we all have gotten kind of used to that. Still, it's still a little difficult to reconcile that when you have, for example, a retail operation that has cash transactions and they have, well, I don't know if anybody uses checks anymore, but you have cash, checks, and then you have credit card or other digital transactions. But what's happened is, of course, a lot of our clients are now using cash apps or cash app, things like Venmo or, even apps that are Zelle, things like that. And so those transactions starting in 2023, they were supposed to start after 2021. Now after 2022, they're going to be supposed to be reported to the individual taxpayers for anything that's $600 or more. So back to what we might see as a 1099 NEC limitation is now going to apply to any digital type transaction. That the reason that folks are a little bit concerned about this, I'll say a little bit, a lot of folks are a lot concerned about it, is those third-party transactions are supposed to be only for the business side of those transactions. There is concern there that when someone, sends money to reimburse someone for a meal or to send money to their child at college, that those are going to get swept up in the 1099K umbrella, and they're going to have to reconcile those 1099Ks on the tax returns. Now, what we normally do for a small business, of course, is we'll go to their Schedule C, or we'll do it on the business return or the S Corp, whatever, and we will list those 1099K transactions and then the other transactions now, and we'll reconcile back to gross revenue. That reconciliation is now going to have to occur on a lot of individual transactions that have nothing to do with a business. There was a court case a couple of years ago where there was a settlement of a lawsuit, and the CPA did what a lot of us would do is he wanted to report it, wanted to clarify that there were expenses associated with it. So he put it on Schedule C, and the court was very clear in that court case that Schedule C is only for businesses that are operating for a profit. And so we can't run these through a Schedule C if they're for personal transactions. So what the IRS has done is they've given us an indicator, and in your software, you'll probably see this, whether it's Drake or any other software package. You'll see on Schedule 1 now, under other income, there'll be an item listed for other mistaken 1099Ks. Now, they tell you the first thing you should do, of course, same thing that you would supposed to do for an incorrect W-2. You're supposed to go to the provider of that 1099K and tell them it's wrong and try to get a corrected 1099K. And then if you can't get a corrected 1099K, which of course most of us know that if that occurs, that means the client is now going to have to wait, especially if they're in a refund situation, to get their refund until they get a corrected 1099-K, which could take months to get. So it's reported on Schedule 1 now, and there's an indicator on Part 1, line 8Z, as in zebra, of that Schedule 1, the 1099-K received an error. And then on Part 2, 24Z is the other adjustment that pulls it back out. So that allows the income to go in and have its own particular line, which is 8Z. And then on Part 2 of the Schedule 1 and 24Z, it'll show, incorrect 1099-K received an error is what that'll look like. So those are reportable transactions there. So 1099-K is something we're all going to have to deal with. There's going to be millions of them that have come through. Hopefully they'll all be accurate, but I think we've all been doing this long enough to know that's probably not going to happen, similar to what we experienced whenever brokerage transactions had the first report basis, which is, we may hit that a little bit on digital assets. But that takes us to our next polling question on slide 11. I'll turn it back over to you, Isaac, to kind of hit the next one.
So, yeah, it sounds like the 1099, the K issue next year, if it actually implements this year, is going to be just, well, I guess it is, but yeah, it's such a headache. So how do our listeners, professional tax pros, plan to communicate their 1099-K guidance to their clients? By email, in-person planning sessions, letter, or you don't? You know what? I'm not a tax professional, but I've got 2 or 3, not many, transactions that use Zelle that is over that threshold with a family member or 2. And it's usually they need money to get a car payment done or whatever. And then they pay me back, usually the same method, but maybe a different method. So reconciling those is going to be a headache even for me. Although really it isn't for me comparatively. Once you get into people who have a little more high net worth or are sending more family and friends transactions, not to mention business transactions.
That's exactly right.
We are ready for the results, by the way. Sorry, I went on about that. Looks like most people are email, and then you send others.
We do hope that the 1099-Ks are accurate, right? But and there is in the guidance that the IRS gives to the issuers of the 1099-Ks, it does give them, the ability to say this is personal transactions versus these are reportable transactions. It's just anytime something new is introduced into the process, we all are anticipating that there are going to be personal transactions that are reported incorrectly as business transactions, and probably vice versa. So we're still going to have to reconcile, especially for businesses, those gross receipts, to make sure that they reported all the income that was reported to the IRS. And then, of course, we have some challenges with the transcripts, so they may or may not show up in our search of things that we may have to pay attention to in a timely fashion. Along those same lines, employee retention credit, I think a lot of our clients still are confused, and I think a lot of us ended up confused about the employee retention credit. The IRS has shut down processing. They have not shut down receiving employee retention credit applications. Speaking with the taxpayer advocate, Erin Collins, just a couple of days ago, and she wanted to be sure that folks knew that appropriate ERC claims can still be made. The IRS did provide with a new withdrawal process, and if you pay any attention to the withdrawal process, it's only available for those that when they filed their 941X, they did not have any other adjustments on the 941X. They only filed it to claim the ERC, and then they want to withdraw all of the ERC claim. They don't want to withdraw part of it. In other words, I had 2 employees out of 10 that I found probably didn't qualify for the ERC, so I want to pull those out. You cannot use this new withdrawal process to do that. And then you cannot have received and cashed the client cannot have received and cashed the refund yet. If they file all of those, and now maybe they went to one of these ERC mills that was promising the world, and then they call you and you find out, okay, you probably don't qualify for this, this, and this, and they don't think it's worth the hassle, and you're ready to start that withdrawal process. As it is a paper process, They have to sign along the margin of the new 941X. They have to write particular verbiage on the other side of the 941X, and then they file that withdrawal on paper. Presumably what's going to happen is the 941X claims that are waiting because processing has stopped. It gives the IRS more time to make sure that that withdrawal process is matched with those returns, and potentially they get pulled out of the stack and put somewhere else so that they do not get processed and refund claims don't get issued, which means that the pool of refund claims potentially goes down. If there's already been a question about it from the IRS, any type of challenge from the IRS, then that automatic withdrawal process is not available. And there's even a process in place where if the client received the check but they didn't cash the check, they can void the check, but they have to send it to a different place than they do for the normal ERC. Sorry, not EIC. For the normal ERC claim. So this is something else that we'll have to deal with probably throughout the upcoming tax season. I think we have another 2 years of potential, timeline on ERC claims that can be made, although it's, by the time we figure out all the statute limitations on refund claims. Our digital assets, again, we have new guidance issued from the Internal Revenue Service around digital assets, any digital virtual currency, cryptocurrency, stable coins, non-fungible tokens, all those types of things. They're not fiat. This is the term. I never used that term other than to refer to a car up until a couple of years ago when we started looking at all the digital asset type things. Now, the big thing to just realize here is in 2 years, the brokerage rules that apply to 1099Bs are going to start applying to all of the exchanges and potentially the wallets of digital assets. Whenever I teach a class to our clients, a couple of years ago, if I asked, who here is dealing with cryptocurrency in your clients, and 1 or 2 hands would go up. I was speaking with a group of tax preparers last week in Baltimore of a class, around 200 preparers. There were probably 90% of those hands went up of clients that now are tax preparers that are now dealing with digital assets. So I think we're all familiar with when a particular transaction is taxable, similar to stock. The difference is going to be now when we start getting these 1099 DAs in a couple years. The difference here, and I heard a representative from the IRS speak about this initiative a couple weeks ago in D.C., and they brought up the fact that they estimate, because these 1099 DA transactions are different than the 1099Bs in that they're reporting every transaction, not particularly sales. So when we think of as a sale, we think of a stock that is converted to cash or stock that is converted to currency of some kind. In this instance, that is not the case. It's going to report all the transactions. Right now in 2025, they're estimating we're going to see 8 billion 1099 DAs. Yes, that's billion with a B. And the comments on the proposed regs on this, if those of you that have been around a while and remember whenever brokerage firms first started reporting basis on our 1099Bs, there was a period of time, there was a runway where we had to get those. They had to be trained on how to get those accurate because they may not have had the stock. The stock got transferred to them. And that's what the 1099 DAs are trying to track, is when a digital asset is transferred from one exchange to another, one wallet to another, there's a record of that transaction. Again, trying to move transactions out of a world where the IRS is not aware of a transaction and moving those back into a world where they can at least run their compliance efforts against them. So again, we're talking about reporting on the transactions themselves and not necessarily. So someone moves from one wallet to another wallet, they would receive some type of reporting on their 1099 DA. Now, what does that do for us today? For those of our clients that are holding digital assets, maybe they purchased it quite some time ago, I think it'd be a great idea for us to start thinking about putting basis in their minds and just letting them know, you don't have to pay tax when you sell all of this, because you can deduct what you actually paid for it. We just need to have a record of what you paid for. Again, it's amazing to me how many of the tax cases that we look at every year that would never have even went, to the next layer of tax court if there were adequate books and records kept. So this digital transaction, the good news is, as we think about blockchain, there should be a record of every transaction that's easily accessible, but not necessarily the case, and we all know that. But this is an opportunity, I think, to remind our clients that this is an area of focus. More and more of these digital exchanges have received John Doe summons from the IRS that basically say, we just want to know how many taxpayers and who the taxpayers are that own digital currency on your exchange. And those John Doe summons, along with soft notices to potentially those individuals that own digital currency, there are probably those on this call that have to deal with those notices. Those are, they're not my favorite thing because they don't necessarily give someone a clear indication of what they may have done or what they may be doing wrong, or give them a clear way to respond. But they are indicative of the efforts that the IRS is making to enforce taxability of digital asset transactions. Again, one other thing that we've talked about briefly, and I'm not going to go into them in any great detail. We don't really have time to do that. But a lot of clean energy credits. We've had the IRS take on a lot of different things over the last few years. Instead of tax administration, we saw them, administering healthcare and healthcare subsidies and credits. Now we see them taking on clean energy and green initiatives. Now we see that the limitation on the number of vehicles that can qualify for the EV credit is gone, and individuals can take up to $7,500 of a credit. Those credits are non-refundable, and you can't carry them forward. However, they're well, let me put it this way. You don't have to figure out all of the nuances between the batteries. Did they, the two different ways that 7,500 is split up. You can go to fueleconomy.gov, and on fueleconomy.gov, there are qualifications, and they're actually the actual cars themselves, what the MSRP is, because there's a limitation on the MSRP. $80,000 for trucks, $55,000 for other cars. And it's amazing to me how many of those cars, the MSRP is now $80,000. And how many of those cars are $55,000, and how many of the trucks and vans and SUVs are now $80,000. So we're seeing tax policy drive the particular economic transaction there, but you'll see that on fueleconomy.gov. We don't have to determine when those batteries were sourced or anything like that. The form that you would use for that is 8936. And there's also a used vehicle credit. The used vehicle is 30% of the sales price, up to a $4,000 credit there. The individuals can't have them for resale. The other thing just to keep in mind here, there's a 30-day trade-in notice. So if the car is traded in and within 30 days of actually buying it, then the credit is not available. And if a used car is traded in 30 days or sold 30 days after it's purchased, then it is presumed to have been purchased for sale and not for use. And that does not qualify for the credit either. Now, for businesses, the other qualifications are just real quick. There's an oddball in there on the used vehicles that can't be claimed as a dependent of another and claim the used vehicle credit. And then the seller has to provide vehicle qualifications to the buyer. And then the seller of that, the only way the used vehicle credit is available, and again, that's $4,000 credit. The only way that can be utilized is if it's purchased from a dealer, and the dealer has to register online. I think that online registration goes live for the dealers on January 1st. Presumably, they can sell the used car today, and then January 1st, they would upload all those transactions to the IRS. There are lower modified AGI limits for the used car, too. They're about half of what the $7,500 credit is. And the gross vehicle weight has to be under 14,000 pounds for that. And the cost of the car has to be $25,000 or less. Just as interesting here is the EV credits for business, which has a $40,000 limitation. Again, any credit that's taken has to reduce the basis for depreciation of the client. In order to qualify, it has to be available for depreciation. So basically, it has to be used for business and placed in service. And it is all of these credits for EVs are all around the date it's placed in service and not the date it's paid for. And in service for an individual would mean they're now using it for their personal use within that 30-day window. There's also an odd, I'm not going to go into the actual details of the calculation, but there's an odd credit there. There's an odd calculation there on that business credit. It's 15% of the basis in the vehicle, which is 30% if it's all electric, or you can calculate the incremental cost of purchasing the electric vehicle. And there's a safe harbor calculation that's available. The IRS released guidance on that. And now the commercial vehicle credit is available to carry forward as a general business credit. And it has to be used in the United States. All of these have to be used in the United States. And cannot have qualified for the individual credit and then be converted into business. The home improvement credits, we all have clients that have brought us their home improvements year after year after year, even though they took the lifetime limit, 5 years ago. And we've told them every time we give them their tax return, I don't really need this information anymore. Now you need that information again about their home improvements, because there are, energy efficient home improvement credit for windows, insulation, principal. Some of them are available for renters as well as for the owner of the homes. The main qualification there, it has to be on the principal residence or the second residence, could be a third residence actually, for the energy efficient home improvement credit. And that is, it's not incremental, or it's I forget the term used in the regs, but the doors are limited separately from the windows, which are limited separately from heat pumps. Heat pump, for example, is $2,000. Each of them have their own limitation. Overall, it comes out to about $3,200 in total home improvement credits. There is no more lifetime limitation on that. So now we've got to communicate with our clients and say, hey, bring me back your home improvement. It might be worth getting that higher rating on the heat pump in order to get the credit. And the residential energy credit is even better. Now, the energy efficient home improvement credit is use it or lose it, whereas the residential energy credit does have the ability to be carried forward. That's mainly solar and geothermal type improvements. The residential energy credit is okay for new construction, whereas the energy efficient credit is not. It has to be for a home that's already there. And this next item, I almost pulled out of this presentation just because of some recent guidance, not guidance really, but recent rumblings in the market. We've all kind of dealt with clients that have an FBAR reporting requirement. The Corporate Transparency Act, which a lot of us have been tracking for a little over a year now, it's federal law that has most domestic businesses, if they're organized with their state and they file like S Corps, C Corps, LLCs, if they're organized with the state, they're going to be required to file a beneficial ownership statement. And the beneficial ownership is not necessarily straightforward. It could be someone that owns 25%, someone that exercises substantial control. Presumably all owners and potential senior officers would have to be reported to FinCEN in order to track that beneficial ownership. So one-time filing, they have a year to do it. Existing companies have a year to do it beginning January 1st of next year. New companies that are formed have 30 days to file from the date that they're formed. And this is just things like the name, the date of birth, the social security number, their ownership interest, the nature of their control. Naturally, they're going to come to us as their tax preparer to help file these types of documents, similar to the way a lot of us may do an annual report with the state as part, as a matter of course with our tax filings. But before you do that, I just recommend you check with your E&O carrier and potentially your state society if you're a CPA. There are some indications and some guidance that we've seen that potentially filling out this form, because it's not specifically being administered by the Internal Revenue Service, could lend some CPAs at risk of practicing law by doing this, and potentially not having coverage if there's a mistake. And the penalties on this are extremely substantial. They're daily penalties. and, could potentially put some, I think it's $500 a day up to $250,000 and 5 years of imprisonment. So obviously there's some liability there. We have heard from E&O carriers, or we've heard some of our customers that have contacted their errors and omissions insurance carriers that have said they won't cover this type of activity for a particular practice. So I just put this on your radar to let you know I'm not recommending that you do or don't do this, but it is something you want to investigate before you do it and ensure that you're protected and your practice is protected if you do decide to assist your clients with this. It leaves a lot of small businesses out in the lurch if you can't do it, and they're going to have to find another way to get this done.
Now, we did actually have one question from the audience asking if the necessary forms would be included with Drake software. Sounds to me, at least since you're recommending maybe they find a legal partner to handle that.
Yeah, it's a great question, and I will tell you, we had plans to provide a lot of assistance around this, the Corporate Transparency Act, similar to the way we do with the FBAR filing through FinCEN. There were some capabilities that were built in as the IRS was administering FBAR fines. However, that is not the case with the Corporate Transparency Act. So we are in hold mode until we know exactly what we can provide and what's appropriate for a tax preparer to actually do. And hopefully we'll have some time here at the end. If we have more questions around that, happy to do it. I put this slide up here, and it's just a representation of an IBM report that was issued on data breaches. And you probably are getting tired of hearing about WISPs, hopefully. I just find every time I talk to a group about this, there's always some confusion about the level of depth that someone needs to go into in order to provide a WISP. And the worst thing that could happen, at least in my mind, is that someone just downloads a template, checks a lot of boxes, and they don't actually stop and take a step back and just consider some very basic questions. So I wanted to just put this in here. The slide here is really motivation to make sure that you're considering security. And it says the type of data attack for a particular data incident, and most of us would think of them as data breaches. But over here on the right is the number of days it took to identify it. So in a lot of these, like an average phishing attack, and they're about 15% of what was tracked, took over 200 days to identify that it was effective. So someone could have been in a system grabbing data or manipulating data for over 200 days before it was actually identified. So what that tells us is there are things out there that we're not aware of that we need to prepare for. So, my top 7 things that you should do is just have something written down. And when you think about what you need to write down what data you have. In other words, I have 1,400 tax returns that I store over the last 7 years, and do that math, whatever number of records that is, because it's not just the tax return itself, right? It's the spouse, it's all of the kids, it's all of that tax data is all considered individuals. And then you have all the source documents that come with that, right? So you may have K-1s for other people, all of the data you have. Just try to give a broad definition of know where it is, know who stores it, what the security is behind it. I password protected, have 2-factor turned on. That would be kind of that. So that's number 2. Number 3 is how are you keeping it safe? Everything's encrypted. Everything has password protection on it. I keep my network firewalls turned on, that kind of thing. And then who's responsible? You have to have a responsible person, and that's probably you. As many small firms as we have on this call, you can't really delegate that to someone that's not responsible. In other words, you can't say, I'm going to hire this guy. He doesn't know he's responsible, but I'm going to make him responsible. Now, if someone's willing to take on that type of fiduciary responsibility, that's probably a different issue. But who's responsible to make sure your data is safe? Who's responsible to make sure you have it identified and secured? And then finally, and this is the one a lot of folks try to avoid, what are you going to do if something bad does happen? Go ahead and have that plan made out now. It's similar to life insurance. Make sure you know who you're going to contact, and I would put your IRS liaison at the top of that list. Your E&O carrier, of course. A lot of E&O carriers will have legal representation for you. They'll have the ability, they'll help work with your state attorney generals if something happens to make sure you're just sending the proper notices, all those kinds of things. But do that now. And that's really, to me, if you do that, you are 90% done with making a WISP happen, which leads us to our last polling question, I think, which is, Isaac?
Number 4, polling question 4, does your firm have a WISP? And like John was saying, don't just fill out a template. There's a lot of templates out there, but there are some real best practices you can get and just real specific advice you can get from vendors like Drake or perhaps from your insurance providers. You need to be specific as you can be. And if we can take a look at some of the results as they come in, well, fortunately, I guess that's good news. And still a lot of people without a WISP.
We've got over 65% dues, so I'm fairly encouraged by that.
And in case my pronunciation is muffled by the internet, that's a written information security plan. And the IRS says if you prepare returns for money, you need to have one. Yes. And it needs to be written. Well, printed.
Or something. Yeah. And it doesn't say, it tells you the elements that you want to have, but it can be specific for your practice. So let me send those results out. And I think that's about all I have. I know I put an AI slide up there, but I think we're right at time. So I will turn it back to you, Isaac.
Okay, I thought I was talking, but I had my mute on. So we do have a few questions. So someone, it doesn't say if it's a business return, but I assume it is. They filed 22 return in April and $40,000 refund expected, and it still says pending. Well, I think a $40,000 refund, if it's an individual, will certainly be audited. You think, John? No, it could be a business. It doesn't say. Well, let's find another one. I'm scrolling through.
Well, the IRS, I will say this: if you electronically filed the return, the IRS is almost caught up, if it's an individual return, the IRS is almost caught up in their processing for the individual return. So, Isaac could be right; it could have been set aside, and there could be some additional questions on it. Maybe not to the level of an audit, but they could have additional questions on the withholding and making sure it matches up.
Okay, and I assume that was the actual return and not an estimate or not an extension. There were quite a few questions around the Schedule 1 form for the 1099-K. I think a lot of them were kind of along the lines of my initial fear. I mean, I do remember, and I think this is part of the problem why they couldn't get it implemented, a couple of years ago when they first tried. It was leaving everybody kind of in the dark. And some more questions about CTA, generally the same ones. And to our watchers and listeners, if we don't address your points, someone from the team will get back to you. I'm not saying anything real pressing. I'm going to turn it back to you, John. Is there anything last minute that you'd like to address while I look through some of the?
Well, I did have a slide on AI, and we're seeing that more and more. The IRS is going to utilize it to help select, especially large partnerships for audit. We're going to see more and more of that come down in the next couple of years, but it is already being used today. Most of us have hopefully played around with it a little bit and we're familiar with it. We'll see it impact the tax and auditing especially. There's a lot of new startups around the auditing side trying to make sense of big data. I think all of us need to consider how we add value to add value to our clients as we continue to serve them in ways such as tax preparation to become less about the actual preparation and more about the results of that preparation.
There were a couple more questions about WISPs. So here's a watcher asking, does this person need a WISP if him and a couple staff members are employees of an S Corp, but they do the returns for the shareholders and the data is inside protected company firewalls, but they are not a CPA firm and they don't address whether or not they are themselves a CPA or an EA. So they're employees of an S Corp doing the returns for the shareholders.
So yeah, the real question there is it for compensation? And normally if you are an individual working for a company and you're doing that company's tax return, you're not considered a paid preparer as such. You're considered just an employee of the company doing your tasks. So if it's part of your job description, normally I would say you're not a paid preparer. However, from a very broad reading of the law and the requirements, especially if you have an EFIN, an electronic filing ID number, those preparer rules are broadly defined. A tax software is a preparer under some of those regs, like 7216. So it does something that it would bear you considering. Although my first inclination, and this is not based on any research that I've done on that issue, is that you're doing your duties as an employee, which would normally not entail having a WISP.
Okay, one short question, and then we'll wrap it up with one more. One more on WISP. Do you have to have a WISP in order to get your PTIN?
You do not, but there's a question that you will find at the end of your PTIN that says, do you know you have the security requirements? And I'm not sure how the question is worded today, but if you read the question carefully, I think if you're going to follow the security rules you have to have a WISP.
Okay, and from another, I was going to say reader, another watcher, will there be any major updates to Drake for this filing season? And of course, you never know on the tax law issues, but are there any other features or functions that you guys are going to be introducing?
This is a great segue. So we have, I would recommend that you sign up and listen to one of our webcasts that go through a very long list of some very cool things that we're doing in Drake this year, a list that is too big for me to address in the 30 seconds we have left. So,
okay, I think that is going to wrap us up for today. We hope everyone enjoyed the CPE webcast. If you have any issues with the CPE credit, or you need to ensure that you're getting credit for more than one person, you need to send an email to editors@cpapracticeadvisor.com. That's editors, plural, EDITORS, @cpapracticeadvisor.com. And make sure you send us the names of those attending along with the credential. We also want to thank drakesoftware.com for helping make this possible and enabling us to offer that CPE credit to everybody. Immediately after I'm done, you'll be presented with a post-event survey. It is optional, and you will receive your CPE certificate or your CE credit certificate in your email inbox. The email that it comes from will probably be webcast admin. So in case it ends up in your junk mail folder, just search for webcast admin. And one last note, the slides that John showed today, including all the stats and other changes coming to the tax season, those slides are available for download. The deck is in the event resources, which should be on the left side of your screen. Okay, and now I want to let you know that we have come to the end of our event, and well, it's going to end in about 5 seconds. So
thanks for having me, Isaac. I appreciate it.
Thank you, John.